All right. So what do you think? You were saying something about how if Jay Powell was fired, that could create some downstream effect on the market perspective of Fed independence, and that would somehow create a rally in stock markets or a sell-off in U.S. bond markets. What were you saying?
Equities in general, from what I'm seeing. And it makes sense to me because you've got a new Fed chairman that comes in. They're cutting interest rates because, I mean, we can't deny it. The administration in office is more capitalist.
Right.
Right. And so if it's leaning that way and that has some influence, and a Fed chairman who endorses current administration, or they're the ones who kind of handpick the guy who gets nominated, I think the equity markets will love that. And I think you'll see a lot of money flow back into.
Why? Because they're going to cut rates, borrowing's going to be easier, business is going to grow.
Exactly.
Yeah.
Which the concern with that is inflation is not at least fully contained, at least from what we've seen, right? Or I guess I don't know. The commentary from the Fed, which
the conjecture is that inflation isn't over, but the reality is we're at 2.4% and continuing to trend down. So it seems a lot. It kind of seems to me like that piece of the puzzle is a lot of political rhetoric.
Yeah, and it could be.
And undertones of just kind of fighting and basically saying Trump sucks or Trump's great, depending on what side they're on.
Yeah.
It kind of seems that way. What do you think? I feel like inflation is practically solved. Like people were tripping out about inflation being affected by tariffs. Not happened. It's actually come down.
Yeah. I think it's just a more delicate balance that needs to be played, in my opinion.
Like
because really, when has there been a time in history that we've cut rates to zero? And even like in COVID, for example, it wasn't just cutting Fed rates to zero. It was now the government was printing money to buy treasuries, bonds. But
we're talking about different things.
Yes.
We're talking
I'm just talking all
like a
encompassing
depression level economic crisis that caused them to drop rates to zero and print money. That's not where we're at today.
But do we know the repercussions of quickly cutting to zero?
But what makes you think that they're going to cut to zero?
Well, that's what's been said. They're going to cut 3 points, which that gets to range in between 1 to 1.5. Because we're at 4.
We're at let's just look.
Now, or 5?
4.5, I think. We are at 4.25 to 4.5.
Okay. I mean, I think another possibility is stocks start to rally again, which they already have, but equities take off again.
Yeah, what's nuts is that we have hit new highs in the S&P. In I think in all of the indexes, we've hit new highs again.
But you don't really see one, unless there's government interference, which I guess is what I was trying to get at. You don't really see equities and stocks hit all-time highs and rally, and the markets are doing great, and then you have really low mortgage rates. You know, there's short little times in history, and COVID, for example, was one of them, but that was because behind the scenes, the government was buying these bonds.
Right.
So I guess realistically, like I don't think it's false to expect a softening in mortgage rates, but a lot of people are thinking like a sharp decline in mortgage rates.
For sure. And this is what I wrote down as I was thinking through how are we going to talk about this topic, because it is a fully loaded topic. If Jerome Powell effectively gets fired or replaced, whether he gets officially replaced or they've talked about like a new shadow Fed president coming in while he finishes his term, but he's really going to be influencing the FOMC members and behind the scenes making things happen. So what I wrote down, and then let's pick this apart and you give me your counterpoints to my perspective here. But I said it will likely lead to the lowering of Fed funds rate, almost certainly. But what does this mean? Well, what it means, and the underlying reason that this is so critical and why Trump is pushing so hard is because, and honestly, even what's his name, our favorite economist. I sent you a video on him this weekend. Ray Dalio.
Oh, yeah.
He even says this is part of the critical piece for America, the United States, I should say, to maintain their economic powerhouse position. So I put the U.S. needs the Fed funds rate to come down because the U.S. has $35 trillion in debt that it needs to refinance. Well, if
it's by 2027, right?
Yeah, but a lot of it's coming due this year and next year. So if currently the budget has a deficit for many reasons, but one of those reasons, in a very large part, could be pointed towards the cost of interest on the United States debt.
Oh, yeah.
Well, if the United States has to refinance that debt at a tremendously higher rate than because imagine when that was all financed back in the era that you were just talking about. It was financed when rates were at historic lows. Now we got to refinance at recently historic highs. That's going to create it. It's almost spells default for the United States of America. So in my view, to maintain economic power chips, the U.S. has to refinance this debt at lower rates than currently available today. So, but just because those rates go down, to your point, doesn't mean the mortgage rates fall. Mm-hmm. And why is this? Well, it has to do with supply and demand in the bond markets. So the United States of America will still have budget deficits, probably more extreme budget deficits than it previously had before this refinance. So the government will have to continue issuing treasury bonds, because that's how the government raises money to pay for its things, is they issue treasury bonds. Well, treasury bonds compete directly with mortgage bonds. So these are two separate things, I guess is my point. Mm-hmm. Have to refi to maintain the economic power of the United States of America, and you have to refi at lower rates is what I should say. That doesn't mean mortgage rates are going to fall. Quite the opposite to your earlier points. They're going to have to keep printing or issuing treasury bonds. Treasury bonds will compete with mortgage bonds. Mortgage bonds will take this. Treasury bonds theoretically are more desirable than mortgage bonds. Mortgage bonds are like the subprime of the best bonds. So when there's demand being stolen away from mortgage rates, there's no reason to believe that mortgage rates are certainly going to fall as a result of Fed funds rates dropping. I don't think they'll for sure rise either, but they're not going to definitely fall. Mm-hmm. But for sure, the Fed funds rate has to come down. Yeah. Because it's the destiny of the United States of America at hand.
Mm-hmm. Yeah, and I mean, I agree with you. And that's the main point that I was trying to make with mortgage rates, is that that's so uncertain, and there's a much more delicate line that they're walking to accomplish mortgage rates coming down. Because also, if you get the Fed come in and cutting rates, and investors see way more growth in another market, why would they tie up their money for that long?
For sure, because now businesses borrowing money, it's going to be cheaper. So businesses are going to grow, and tech companies are going to go haywire again. Right. So the stock market's going to do better. Yep. So again, but that's what I'm saying. I feel like people get confused. We're not hearing, if you know what you're talking about, when they say the Fed's going to drop rates, the reality is that doesn't mean they're going to drop mortgage rates. It has nothing to do with mortgage rates at all. Right. And so we're just essentially, you and I, saying the same thing, disputing the fact that Jerome Powell getting replaced, a new Fed president coming in, slashing Fed funds rates, all these things is awesome. It could be great for many reasons. In the stock market, could see huge things. There could be risks involved. To your point, it could be inflationary. Right. It almost certainly is going to happen because the U.S. has no choice. And even Ray Dalio, who is very central on a political standpoint, said this is one of the three things that has to happen. They got to raise taxes. They got to get the debt refinanced at lower rates, and they have to cut costs. Those are the three things that have to happen. Cut budget, refinance at lower rates, raise taxes in order for America to sustain. So, but the crazy thing is, like, so many people get confused that has something to do with mortgage rates. And the reality is, I think it's far-fetched to say they're going to go up just because I think
we're already dealing with the worst of it at this point.
Yeah.
I don't think the demand for mortgage-backed securities can go down further from where they're at.
I mean, we're at 40-year lows of demand. Yeah. I mean, it's insane. And we don't have, and the crazy thing is, some of this stuff that's happening politically, not directly in alignment with the Fed president, but some of this stuff happening politically is helping relieve bank balance sheets that will enable them to acquire more bonds, whether it's treasury bonds or mortgage bonds. So that could actually have some of this political movement could be beneficial for mortgage rates. Yeah. But I think, here's my thoughts, and this just came to my mind as we're talking. Like you said, lower rates is going to create lower borrowing costs for consumer debts. Think your HELOCs are going to go down for sure. Yeah. And businesses. Business credit's going to become cheaper. Growth is going to happen. Stock market's going to go. Well, if the stock market goes, people keep making money. And if people make money, they're going to be more inclined to invest in other things. So just the sheer
Especially
fact,
something that doesn't tie them up for years.
right. So just the sheer fact that there's more production happening could actually result in lower mortgage rates.
In the long term, yeah. I think it's really deficit driven and inflation driven on the mortgage rate side. So like you said, what Ray Dalio was saying, there's a deficit issue. I mean, the tariffs, we haven't really seen the impact on those yet, but it could bring, and the negotiations that could bring the revenue, the additional revenue that the U.S. needs to hopefully not increase tax dollars.
Which is kind of the hope.
It's like, I would rather pay a higher mortgage rate than pay more taxes.
Yeah, for sure. Absolutely.
You know?
Definitely. Then pay more income taxes. Definitely.
Yeah, that's why I think that the direct line to mortgage rates is way more complicated.
There isn't a direct line.
I think it looks like that, right?
There's not
really
a direct line,
no
right?
direct line.
Yeah.
It's simple to say you get a new Fed chairman, yeah, Fed rate is going to get cut. Like I would say almost immediately. Mm-hmm. Just based on what we've been seeing. I mean, Trump's made it pretty well known that that's the plan as soon as he leaves office. Mm-hmm. But it's tough to say. And that's why I think, I mean, yeah, I think we could rule out the fact that mortgage rates push up significantly. Maybe you see some volatility, some uncertainty in the short term, but it's also tough to say that you see significant improvements in the short term. Maybe in the long term, if we get on a more sustainable economic path where the deficit starts to lower, businesses can start hiring again, and the economy starts generating some more income. It's like this. I mean, it's exactly what Ray Dalio says, but it's,
you know, what's interesting that
simple in concept, hard in execution.
Mm-hmm. You know? Well, for sure. And what I just thought about as you were talking through that was the markets really dislike a lack of certainty. Mm-hmm. There's a counterpoint here. You were talking about it, I think, before we got on, in that if it is viewed that there's too much political overreach and puppet strings moving the Fed, that could be viewed a certain way and in a poor way. However, if the markets are like, okay, well, for the next 3 years at least, or however many months we have left, for the next 3 years, we know that this Fed president that was just installed is effectively a puppet of the current administration. Mm-hmm. If they have, or if they believe that that's certainty, that's certain.
Yeah.
Well, markets are going to be making more confident, less volatile bets. Right now, the challenge with mortgage rates and why everything seems to have been just stalled.
There's no certainty on the future of the U.S.
No one knows what Jerome Powell's going to do. Mm-hmm. And no one has known. That's been the biggest gripe. That's why Trump's so mad at him, because Trump is largely a private player, right? I mean, he's a huge political figure now, but his whole life he was just in the private markets and trying to gauge things. Yeah. What he doesn't like is there's no certainty. It's like, well, we might drop rates, but we may not. We're just
exactly
gonna have to
the commentary. It's 1 minute they think we're on the path to cutting rates, and you see movements in the market from that, and then the literal next month, some report comes out and they justify the reason why they may not be cutting rates. And right. it literally is this back and forth, and it has been for 3 years.
So that uncertainty has caused this spread in the treasury yield and
why would
mortgage
you lock
rate.
your money for that long on someone you're not certain in?
You don't even know what the heck's going to happen.
It's like a CEO of a company getting up on the stand and saying, we might try and launch this product, but we're not really sure if that would actually sell. So we may do this other one. We
might sell pizza, but we might also build a new car.
But anyways, invest in us.
Yeah, right.
Like we need money.
Yeah, for sure. One thing that I think about too, that is favorable for the United States, and this is my personal belief, but I love the United States, and I believe in it. My personal belief is, does your home and auto insurance seem to go up every year without fail? Mine did too. I thought this was just the way the insurance industry worked until I found my friend Alan Johnson with American Family Insurance. After more than 15 years with the same insurance agent, he saved me over $3,000 per year when I switched. I refer all my family, friends, and clients to him, and their experience is similar. Great rates and a great experience. Call Alan for a free quote today at 801-708-2962. virtually every other powerful economy that even is remotely close to ranking highly in the world is in a worse position than the United States is right now. So the interesting thing is if there was some certainty formulated, like there's a lot of uncertainty with the Fed, but also a lot of uncertainty with tariffs. Where are they going to go? What's going to happen? It's like every other day, something's different. And with Trump, you never know what the hell's going to happen. Like tomorrow, he could just be mad and say he's got a 2,000,000% tariff on China, and suddenly we're at war. Like, you know, you don't know. So there's so much uncertainty, but that uncertainty is equal among every nation in the world, not just America or the United States.
Yeah.
So if there is more certainty created somehow in the United States, well, there are massive issues in Europe, all over Europe, economically. There are massive issues in China, massive, both politically. Like, I read recently today that there's potential for like an upheaval, like a rebellion against the current administration in China. Like, they're making desperate moves because political or socially, people are not approving of what's happening. I mean, it's a straight up, practically dictatorship over there.
Yeah.
They control everything. But then their real estate market, which is a huge piece, and their shadow banking that has to do with the real estate, is legitimately in shambles.
Yeah.
Billions and billions and billions of dollars just gone. There are cities that are brand newly built that are not even, they're tearing them down now.
Or halfway built and vacant.
Or fully built and vacant.
Yeah.
Like they call them like ghost cities or something like that in China, where there's legit cities no people don't live in or work in. Yeah. So it's like, where else are people going to put their money? If
I guess
we create
the reason
some
why
certainty,
I had my standpoint on this is maybe a little bit more principalistic. Shocker.
Yeah, it is all about the principle.
I don't like the game of let's just hope that everyone else is in a worse position than we are. You know what I'm saying? And I know I do think the U.S. does a good job at positioning themselves always, which is great. I mean, I love the U.S. too, and I hope that we continue to do that. But I think there should be some actual changes in the principles of money.
Oh yeah, I mean, of course, government. That's basically we have to. Otherwise, we're just punting the ball.
And that's where my standpoint was with, okay, yeah, you get a new Fed chairman come in, cut interest rates, things are low again, business is booming. Are we just kicking the can down the road? Do we actually make a change? Or are we just going to be in these same boom and bust cycles, which, I mean, we always talk about, that's why you should never wait. I mean, you shouldn't really base your decisions to buy real estate off of that, because how many boom and bust cycles has the real estate market been through? And
for sure. But it's also unreasonable to say, well, we shouldn't do that and we should just let the United States of America default.
Oh, yeah, for sure.
That can't happen.
Right. That's why they're in a tough situation.
Yeah. They have to do it. So all I'm saying is I agree with you. Like, is it good or I'm not placing my opinion on whether or not this is appropriate to perform this way. Mm-hmm. What I'm saying is, if we create some level of certainty, there's tremendous uncertainty everywhere, and any uncertainty that exists in the U.S. ripples throughout the world. They all feel it the same. So if we create an asymmetrical level of certainty compared to the other nations around the world, that could drive even international money into our bond market. Yeah. So that could be the argument where maybe rates do improve, mortgage rates even.
Yeah, it's really a confidence thing. Yeah. I mean, they get someone in the chair position that brings confidence back into the U.S. Like you said, I don't even think it ends with U.S. investors or local investors. I think other countries are like, wow, we're in a terrible spot. If I want to park my money in a secure, like fixed return investment, everyone looks to bonds or similar types. They're certainly not going to be buying their local government's bonds or treasuries.
Right.
You know, so that could be the impact of him leaving, right? Is more confidence restored, mortgage rates coming down because of so. And maybe there's a more balanced market that we see with borrowing costs for businesses and just Fed rate costs in general being lower. So the economy is stimulated, but not too much to where you lose the demand.
That's what I was going to say. You're right, because the scary thing is can we overstimulate when really we kind of need a reset? Like we can't just go back into rose-colored glasses.
I know, and that's what I'm seeing right now. I'm like, we can't just be like, oh, everything's good. You know, we're right back to where we were. Obviously, there's still
and if the opportunity exists, the fact is we aren't disciplined enough as a nation or as human beings to be like, you know what, this opportunity's here for me to selfishly serve myself and my family, but because I believe so strongly in the principles of the way of America's future in the next 50 years, I'm gonna not invest in that. There's no way. People it's gonna go on a run. So your risk is it's a legitimate risk. You wonder if they'll put some weird, because the crazy thing is the Trump administration has done unique things like Doge, for example. Unique things that are not typically implemented, or they're not customary things politically that have happened in recent history.
Yeah.
So do they come and say, hey, we're going to lower Fed funds rate for only this asset class? Is it only federal debt?
Mm-hmm.
Do they split what the rates are so that it doesn't create this, it doesn't stoke the steam of the economy
in areas they don't
take
need
off.
it
Right.
to be stoked.
Right. That'd be interesting.
It's just I don't fathom that could even happen.
Probably not, because there's such an opportunity for all these rich people to make a bunch of money.
I know.
So it's like they can make a bunch of money under the guise of, well, we had to refinance the debt, and hate us for the subliminal effects being a huge rally. It sucks, I know.
Make money while you can.
Right. For sure.
Because we'll be back in a similar spot in probably another 10 years.
Yeah. Oh, it's crazy. Well, time will tell. I think the takeaway is Jerome's going to get replaced. Whether it's now or it's when his term actually ends, he's going to get replaced. When he gets replaced, I think it's basically a certainty Fed funds rate it's going to come down in a very significant way. It's going to make borrowing cheaper in certain ways, but it does not directly impact mortgage rates. And frankly, because of market dynamics, mortgage rates could stay the same. I doubt they'll go up, but they could very well just remain elevated because there's other headwinds that are up against it. So and that's what I've got. Anything you have to close?
No, I think that's it. Confidence and clarity. If we get that out of the next Fed chairman, I think we could see mortgage rates drop, but it's too tough to say. I mean, we got to see it unfold when it comes. For sure. And I would close with this. We are just a couple of mortgage dudes trying to figure out how to do our business to the best of our abilities and understand what's going on. We're the furthest thing away from the smartest people in economics and understanding all this stuff. So if somebody's watching this, or if you know somebody that should watch this and could provide some clarity, we would love their comments, their counterpoints, their thoughts on what this means for the economy. And frankly, if somebody's awesome, I would love to have them on the show and understand what we need to understand if we're missing something big, because there's a real possibility that we are missing something. So please comment, share this, and be sure that you're subscribed if you're not already. It does help us in a big way. So please subscribe. We can get cooler guests on, like maybe that person that knows more about economics than we know. But yeah, subscribe, like this video, comment, do anything you can to support us, and we appreciate you tuning in.
Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.